Welcome all for joining NHC and our Restoring Neighborhoods webinar on State Housing Finance Agency's role in addressing affordable housing challenges. If you're new to our webinars, we're glad to have you. If you joined us for past webinars, welcome back. I'm David Dworkin, President and CEO of the National Housing Conference. Before I introduce our speakers, I want to share a little bit of information about NHC. As the oldest and most diverse coalition of housing advocates in the United States, NHC has worked to defend the American home since 1931. Today, we work with over 320 members on a range of policy initiatives that include increasing Black homeownership, Community Reinvestment Act modernization, and housing finance reform, as well as working with our members to develop a National Housing Act for the 21st century. I hope you will consider joining our work as an NHC member if you're not already one. You can view membership information in the chat box. A few housekeeping items. First, please submit your questions using the Q&A function. Questions will be answered following the presentations. This webinar is also being recorded, and all registrants will receive a link to the recording as well as PowerPoint presentations. It is now my pleasure to welcome our panelists whose organizations recently received an award from the National Council of State Housing Agencies for their innovative work in affordable rental housing construction. Tia Boatman-Patterson is Executive Director of the California Housing Finance Agency, where she leads their efforts to create and finance housing solutions in the largest housing market in America. She engages mortgage lenders, affordable housing developers, state and local agencies, advocacy organizations, public officials, and private financing markets so that more Californians will have a place to call home. Under her direction, Cal HFA has increased its single-family lending from essentially zero to $4.1 billion last year, and closed multifamily loans, including Mental Health Services Act and conduit issuance, totaling more than $2.7 billion. Since 2016, Jeffrey Sykes has served as Chief Financial Officer at the Michigan State Housing Development Authority. Mr. Sykes first joined MSHDA in 1988, where he has served in a wide range of roles, including auditor, accountant, chief accountant, financial manager, and director of finance. So thank you both for being with us today. And Tia, let's jump right into it.
David, thank you for having me, and I'm really looking forward to this conversation, and I'm excited to hear Jeffrey's presentation as well, and then get to the questions from you in the audience. First, I'm going to talk a little bit about California's immediate term response to COVID and give you some thoughts and priorities I would like to see at the federal level, and discuss some innovative production efforts that we are working on here at the California Housing Finance Agency. Of course, it should be noted that those federal priorities and productions efforts are also part of responding to COVID, which has made our country's affordability challenges even more dire. So Andrea, if you'll advance it to the slide 2. So I wanted to start by quickly mentioning a couple of things Cal HFA did early in the pandemic to try to do our part to make sure that our portfolio projects and tenants in those projects are taken care of. Now is a good time to mention that California, we have 4 different housing agencies. We are the state's affordable housing lender, but we also have a sister agency that handles our allocation of bonds and tax credits. And we have the Department of Housing and Community Development that handles our housing policy. But while we aren't much on the front lines in terms of tenant and their protections, we did want to make sure that we kept our goal of keeping people's housed and preserved during in our affordable housing developments. And with that in mind, when the pandemic hit, we accelerated our process for drafting a tenant grievance program. And then we quickly stood up a hardship request procedure for our developers and owners of our portfolio projects. So far, we have not received any forbearance requests, and I think it shows that deed restricted affordable housing is actually holding up pretty well. It is the unrestricted housing that is naturally affordable that the tenants and the small landlords, I believe, are struggling the most. And this leads me to the other CalHFA initiatives that are not directly related to COVID response, but those are our National Mortgage Settlement Fund, housing counseling, and mortgage assistance programs. As part of the COVID adjusted 2000-2001 state budget, CalHFA was allocated $300 million in funds that California had to spend over the course of a period of time. But CalHFA is using that first $50 million to provide free counseling services by HUD certified counselors to California's homeowners, former homeowners, and renters. Phase 2 of the initiative will try the idea of assisting with mortgages for small landlords with 1 to 4 units. So that's a program that we're still working on, but we're really excited that those first dollars of the housing counseling agencies have already gone out to our intermediaries so that those renters and tenants who are facing COVID-related issues now can start getting the housing counseling services that they need. When we look outside of CalHFA, I'll just mention a couple of efforts by the governor's office and the legislature undertaken to give relief to Californians struggling with COVID. We have Project Room Key, where the governor has made $800 million available from the California CARES Act money, available for local governments to purchase and rehabilitate motels and other suitable buildings into permanent long-term housing for the homeless. And I have to get out a shout out to the Department of General Services, who also just won a national award for the toolkit that they put together for local governments to quickly go out and assess whether a building was right for conversion from a hotel motel into permanent supportive housing. So a shout out to Department of General Services. Next slide. No. Oh, with the eviction, not quite yet. With the eviction cliff that we were also coming with the legislature, the governor and the legislature also passed a tenant relief bill that extends eviction protections from February 1st, 2021, as long as the tenants can pay 25% of their rent from September through January. But as Governor Newsom also says, the state on its own is not enough, and we really are going to need more resources and federal support. So let's go to slide 3. The federal wish list. Thankfully, there are some changes that the federal government could make administratively without legislation that would have a huge impact on production and accessibility of affordable housing. The first one is the review of the Federal Financing Bank HUD HFA risk share program through U.S. Treasury. There are about 14 housing finance agencies that utilize this program, and it was just getting up and running. And administratively, it was shut down. I think that was very unfortunate, because this program provided a key source of low-cost liquidity to multifamily programs at a time when the multifamily market was still recovering from the recession. But what was so wonderful about this particular product is because an HFA is unable to securitize its risk share, and because FHA-backed loans take such a long time to close, sometimes 9 to 12 months, this allowed for liquidity for even small loans in rural areas. And our closing time was probably 60 to 90 days. So the speed of execution, the process in which we were able to do that was actually very good for housing finance agencies. And I could see that being a very good tool for recovery efforts in some of our disaster recovery areas, and to quickly be able to do refis in some of our areas in which we're trying to make sure that we're continuing to help our most vulnerable citizens. The other change that we could make administratively is a return of Fannie and Freddie FHA preferred products to assist homeowners up to 120% of the area median income. Last year, the GSEs reduced the cap in which they were able to provide an HFA preferred on a conventional loan to homeowners to 80% AMI. And I really saw that sweet spot between 80% and 120%. We had a lot of Black and brown borrowers that were able to use a conventional loan product. They had the ability to pay, but for down payment assistance, which housing finance agencies usually pair with their mortgage products. And so we're losing a whole opportunity to help Black and brown borrowers by ratcheting down. So I really would like to see the regulator allow the GSEs to meet their duty to serve by helping homeowners at 80 to 120% AI, because their duty to serve really is to help low and moderate income borrowers. Slide 4. My wish list long term, when I look at what must be done through legislation, the number one thing is rental assistance. There have been several proposals, and the most notably is the HEROES Act that is currently on hold because of the $3 million price tag is pretty much a non-starter. You know, the HEROES Act included $200 billion for housing and homelessness, $100 billion for rental assistance, and another September aid proposal. This one was a bipartisan group that David is aware of, was the Problem Solvers Caucus, which offered a bit more of a compromise, going down to 1.5 trillion with a total of 25 billion for rental assistance. So while these projections and the need could be closer to 40 billion, this range might be something that we could push through. Another big help would be enhancing the federal housing credit and bond allocation programs. When we talk about bonds more and more, the states are becoming more oversubscribed. And here in California, we're really seeing that. And that's creating a huge bottleneck, especially when we're using our state resources to make the bonds and 4% tax credits work. There are a couple of federal changes that could help with that. Easing the restriction to at least 50% tests for the projects that must be funded by private activity bonds, changing the formula to increase the bond cap for each state even temporarily, and allowing states to redesignate the carry forward amounts. There are various ways we can strengthen the low income housing tax credit, but most notably creating a minimum rate for our 4% tax credits, which you know right now has a floating rate. If you'll advance to slide 5. Now I'd like to tell you a little bit about CalHFA's production efforts, in which we've leaned in to try to create jumpstart rental construction, new construction here in California, because we do know that in California it is a large supply issue. But until we get some of those changes at the federal level, we have been working on these innovative things. We have our mixed income program, which did win the National Council of State Housing Agencies Award, which along with Jeffrey was honored for Outstanding Construction Rental Housing Program. MIP, as we call it, was created in 2019, and then it really took off at the beginning of 2020 because the governor provided funding resources and an enhanced state tax credit reservation in the last state budget. The key tenets of the program is that it provides a subsidy loan to projects that took advantage of income averaging to serve a mix of incomes between 30% AMI and 120% AMI. Our outcomes were really outstanding from a fair housing standpoint and from a financial and time perspective. We did a comparison of other projects that went through the same round of bonds and tax credits and had used other subsidies that were more costly and took more time to assess. Our analysis found that our mixed income projects will cost less than $100,000 per unit and is projected to get built nearly 1 year faster. From a fair housing perspective, the cost efficiency allowed us to put these projects in higher opportunity areas, and even ones that were in lower resource areas, they have a mix of incomes so that we avoid concentrated poverty. The other program I want to touch on briefly is our bond recycling program. This is brand new, and it was designed in response to the bottleneck that California was receiving with its constraint on volume cap. As I mentioned earlier, about a year ago, we started working with Apple and their subsidiaries to work a deal with the governor, in which Governor Newsom, they had committed $2.5 billion to address the housing affordability needs in the state of California. With Apple stepping in with some of their investment money to provide a credit facility to CalHFA so that we can warehouse the recycled volume bond cap instead of allowing it to expire. Then the bonds can be reused in a new project to help finance more affordable housing. Recycled bonds cannot be used to assess tax credits, but they can be used as additional tranche of low-cost debt in those tax credit deals. or it can be actually used in 80/20 deals in which those type of projects, mixed projects with market rate and affordable housing, aren't seeking to get a federal tax credit. It is a large, an additional source of financing when it comes to our affordable housing resources that we so desperately need. And I look forward to hearing from Jeffrey in his presentation and then getting to questions from the audience. So thank you, David.
Thank you, Tia. Jeffrey?
Okay. I do not see that I'm sharing the screen and that my presentation is showing up.
Not yet. No, wait, you started sharing. There you go.
There we go. Okay. All right, I'm going to spend the short amount of time I have this afternoon in discussing affordable housing to stick with multifamily gap financing ideas. And so, again, I'm with the Michigan State Housing Development Authority, and I too, along with Tia, was the recipient of an award from the NCSHA for our below market rate bond program. So we're going to talk a little bit about that. First, I think everybody is going through a lot of the same challenges that we're having in the state of Michigan. COVID-19, there's an increase in the cost of building materials, limited gap financing dollars, and unemployment, the inability to make the rent payments. And some of the resources that we have available to us are the coronavirus relief funds. The authority has taken $60 million of those resources and used those for an eviction diversion program. We've also had put in place some short-term payment deferrals, allowing some of the developments that are having difficulties to have interest-only payments for a short period of time. And then the other thing, in order to kind of keep the ball rolling and creating affordable housing, the authority has been working on creating flexible gap financing. And so with that, we'll talk a little bit about the capital stack. And so when we're putting a multifamily development together, bringing it to feasibility, the typical capital stack includes, a first mortgage, soft funds, and soft funds are typically the kind of funds where it's in second or third position, and repayment is based on cash flow, excess cash flow, or available cash flow to pay those funds down. There's typically you'll see federal resources, home dollars. There'll be low-income housing tax credits. And then sometimes asking the developer to defer some developer fee. And to the extent that the sources are less than the uses, a gap is in place. And so oftentimes we find that there is a gap. And it's those gaps that prevent us from getting as much affordable housing created as possible. We tend to have more demand for these resources to bring deals to feasibility than we have those resources themselves. One of the things that we've noticed over the years, for a number of years, that we've had social impact investors reaching out to the authority, showing interest in trying to get affordable housing in their community. Sometimes it's a business, sometimes it's a local area, a local government unit looking to get something done in their area. And at that point, we would sit down with those interested investors and talk to them about what it would take to bring that deal to feasibility. You start going through underwriting, when it is that we think that their funds would be paid back, or if they would be paid back. And it becomes very complicated. I mean, low-income housing tax credits, federal programs, state programs can be very complicated. And over the, say, 15, 20 years or so that we've tried to accomplish bringing in a social impact investor into a multifamily development, not once were we successful. And really, that's where the authority's below market program helped us to achieve that goal for the first time. We had a potential investor come in, and we started discussing this, and it was heading down that typical path of we weren't going to be able to bring this deal to feasibility. And it kind of dawned on us that what if we discussed with them the option of purchasing Michigan State Housing Development bonds below market rates. So for example, and I think everybody on this webinar understands that when we're selling tax exempt bonds, we're restricted to a 1.5 spread. And so to the extent that anything that we can do to reduce our cost of borrowing, our cost of capital, and we tack that 1.5 spread on, all of the benefit of lowering that cost of capital goes to the development. And so to the extent that we could find an investor that was willing to take a 1% return as opposed to what was in the market for bonds that would be outstanding for a 40-year period of time with level amortization, what that did is that brought the cost of lending down to that development. And with that lower cost of borrowing, the development was able to afford more mortgage, which is another way from which to fill that gap. And so to the benefit to the investors is that there's no longer that underwriting of an individual development. So there's not that sort of brain damage that goes into trying to figure out how these federal programs work, what's the cash flow of these developments, if there's difficulty with that development, what's it going to take to get those funds repaid. All of that is very complicated. And so what it switches over from looking at the individual development to looking at the Michigan State Housing Development credit and showing the potential investors that the authority's got an ICR rating, issue or credit rating with Standard & Poor's of a AA. So they're looking at a very strong credit. And then they understand that even if that individual development fails, that the authority is still sort of on the hook to repay those bond principal and interest that's due. The other thing is there is immediate debt service that takes place. So that sort of unknown of when it is that that individual is going to be able to receive those funds back is no longer based on excess cash flow development produced by the individual development. Those payments will immediately start to be repaid. And then also there's the fact that these are marketable securities. It's a bond that can be sold into the market. But I think it's incumbent on us when we're discussing this with a socially conscious investor that if you're trying to sell a 1% coupon into a 3% or a 4% market, you'd obviously have to sell that at quite a discount. But the fact remains is that if the individual does want to get out of this particular investment, that option is available to them. The other thing is that when you're actually going out, and one of the things that we learned that's important in having these discussions is that if you put yourself in the position of the potential investor, from their standpoint, it feels odd that they're making an investment in a state entity. I mean, from their standpoint, they're feeling, am I just subsidizing a state program? So you really have to kind of sit down and show them that capital stack and what it is that you're trying to achieve, and be able to explain to them that it's all about that cost of capital, and anything that they do to help reduce that cost of capital goes to the feasibility of that development. So they are truly bringing affordable housing to fruition. It's also important to, we've noticed that having conversations with a couple of foundations that they've said that they also don't want to see that their funds are going in and it's completely to make sure that, say, the developer doesn't have to defer any developer fee, or that they can get paid more or something along those lines. So it's while it does dramatically reduce brain damage, I think it's important to sit down with that capital stack and kind of explain where you are before that investment is made and after, so that you can demonstrate that what it is that they're bringing to the table truly is bringing affordable housing to the community that they're interested in. And really the last couple of slides are just, we've had a couple of developers that have been out talking to potential investors themselves, and we're looking for some sort of a kind of a term sheet that they could share. And so it's pretty simplistic. The first page of these last two pages is just a really quick sort of synopsis of the program itself. And then the last page is a shortened term sheet to just kind of go through and be able to discuss some of the particular terms that would be taking place in negotiating this sort of private placement of these below market rate bonds. delivery date, first interest payment dates, the fact that you can go out and independently research the authority's credit by looking at, again, Standard & Poor's and seeing that it's a AA with a stable outlook. The coupon price at 1%, the term of the bonds being 40 years. We are looking from our standpoint to keep the minimum investment to $1 million. There's concern that we would end up with a whole host of small investors coming in and looking to have individual bonds. And at this point, the authority doesn't have the resources to sort of do that kind of crowdfunding. We have had some discussions about the possibility of having another entity do crowdfunding and then use that to do just one bond, one CUSIP for that particular type of investment. So I hope this is something that's you find interesting, and if you have any questions, we're here to answer those questions. And Tia has talked a little bit about what's going on in California, and if you have any questions for the two of us, we're looking forward to answering them.
Thank you. We are getting questions, and folks should feel free to type your questions into the Q&A box. You can see the icon at the bottom of your screen. Let me start with Tia and ask you, how do MIP projects compare to other bond credit projects?
They came in about 120,000 less than other projects in the same round. And we attribute that to a couple of things: the time and the speed in which we were able to do that. Because we weren't asking for a bunch of different layers of subsidy, and we were able to create kind of a one-stop, that was one of the reasons for the time and execution we were able to do that.
And another question, did the money that Google put up, did that come to Cal HFA too?
So no, and it took a minute to negotiate.
Never too late, right?
Yeah, never too late. I do know that Google was working a lot with some of our regional CDFIs. And so I believe they were investing their money more regionally using CDFIs.
And what kind of oversight do companies like Google and Apple like to have to see the production and management of the affordable assets?
So the way we structured it with Apple is it really is an investment, and they're receiving a return on their investment. So on the credit facility, they're receiving a pretty much as if they were investing in US Treasury bonds. And so that's the cost of that capital to us. And so that's the cost of the credit facility. Apple also is partnering with us on our single family side, in which they're purchasing our mortgage-backed securities. And so they're purchasing those mortgage-backed securities at a price that is helpful to the state of California. And they also are getting return on their investment because it's a mortgage-backed security. So that's how we've structured our partnership with Apple.
Great. And Jeff, you said that you limit the minimum investment to $1 million for the BMRP. What's the average, and what would be your target investment?
The average investment so far is probably about 1.3 million or so. And neither of the developments that have been financed under this program so far had 100% of the financing come from this private placement. So it's a combination of the private placement and market rate bonds being sold. So it's dependent upon what the investor's appetite is in order to get this, get a specific deal done. The first investment did have, I think one of them was 1 million, another was 2 million, another was a little more than 500,000. So it's not that we can't do that. We just didn't want this to turn into sort of, again, like a crowdfunding type program in and of itself. There may be a way, if there is a community that wants to make small investments, that we might be able to sort of herd those cats into one bond. But yeah, we do kind of want to keep that minimum investment right around $1 million.
Great. And has MSHDA received forbearance requests, and how is it working with struggling housing, affordable housing owners that have reached out?
Yeah, we have. It's one of the things that we looked at early on when COVID kind of hit. There was a lot of concern about what was the unemployment insurance. How much would that potentially bring to prevent this inability of individuals to make their rent payments. And so, not knowing immediately, we had reached out to our multifamily developments and let them know that we would be open to a forbearance program. Many of the developments, most of what we have, we hold on our books. We have a real robust asset management team. And so these developments, when we put in place, have reserves set aside to deal with potential issues. And so, we wanted to look at each individual one. So it's not sort of you can come in and just get it automatically. Each deal is a little bit different. So we wanted to take a look and see, do they have the resources to continue to make payments? What we did notice is that the developments that did ask for forbearance were probably the developments that were having a little bit of difficulty going into COVID anyways. And what we have found is that we've been really quite surprised with the low rate of multifamily developments asking for forbearance. But there's probably a little bit less than a dozen or so.
Do you have an idea of why that might be?
Again, I think it has to do with the unemployment benefits having been strong enough, or a high enough dollar amount that folks were able to continue to make their payments. But really, I mean, at some point, we're going to come to the end of those resources, and then it's really going to become dependent upon how the economy recovers. If the economy flounders next year and those resources aren't there, we'll expect to see a higher number of developments looking for forbearance. I think that's another reason why, if the economy does flounder, it's important to make sure that the federal government looks at another round of resources for both single family mortgages, individuals making their payments, and also on the multifamily side, being able to make rent.
That's very helpful. I'm going to come back to that. In the Michigan below market rate program, where are you seeing investors? Are they national, or are they largely from Michigan?
Oh, it's definitely Michigan. So far, the groups that are interested in making investments, it's really a development that's taking place locally. One of the investors is a business in the Kalamazoo area that wanted to see this affordable housing get to feasibility. And that was what kind of brought them to the table. It was in the original discussions with this group were along those lines of being in a second or third position with a soft loan. And again, like I said, is starting to head down that path of based on the questions and the concerns that this just wasn't going to happen. And that's when it kind of clicked, was, well, hang on a second. Is there something we can do from our standpoint to simplify this in order to get this investor across the finish line? And that's when we kind of came up with the idea of having them purchase our bonds through the market. But it's definitely local investors that we've been talking to. We're also seeing in the Detroit area and working with the city of Detroit of trying to round up some investors to sort of put a pool together to get a group of multifamily developments done with this below market rate program, bond program.
Great. Tia, did you have something you wanted to add?
Yes, I think what we're seeing as well here in California, why we're not seeing a lot of defaults or forbearances in some of our multifamily, are that those are essential workers that have continued to work. So they've continued to be able to pay their rent because they're essential workers that have continued to show up at work, in addition to the unemployment.
And you think that's had an impact on the payment of rent as well?
I think it's because those folks are paying a rent that they can afford.
Mm-hmm.
And if they continue to work or receiving unemployment, those multifamily developments aren't showing signs of folks not paying their rent. Where we're seeing the problems are in our small landlords, non-regulated where those folks are paying rent and they're struggling, and those landlords are struggling to pay their mortgage. That at least that's some of the evidence that we're seeing.
That makes sense. And we are really looking at a fundamental change in the landscape here in December 31st, when the benefits from the CARES Act run out. And we're going to have at least a 3-week gap until a new administration comes in. That means the Biden administration is going to have to really deal with a rental assistance crisis. What do you see in terms of eviction filings, and what are your concerns about moving in to January and then February in terms of rental payments and single family mortgage forbearance as well?
I am really, really quite concerned because a lot of states, including California, have some form of moratorium, and mortgages are due and someone must pay. And so we're seeing calls for rent cancellation and mortgage cancellation, and that's not going to make the bill no longer become due. And so what is going to be the assistance that comes in to help continue to help those mortgages continue to be paid? And that, because we are becoming more and more of a rental state, that is, in my mind, it's going to take federal support and a rental assistance in some form to come in to be able to allow these folks to be able to pay their rents, so the folks that have mortgages on these properties will be able to therefore pay their mortgages.
Jeffrey, how about you?
Yeah, I mean, one of the things I would say is that our executive director is very concerned about this, and so we have a meeting every Monday morning at 8:30, and there's a set topics that we discuss. And one of those very first topics is the impact on our customers, and that's both on the single family side and on the multifamily side. So on a weekly basis, we're providing data to the executive team to talk about, where are we from forbearance and from single family, what's going on with multifamily, with rent collections, looking at their accounts receivable to see if we're seeing a problem crop up. And again, it's sort of up to this point, we've been pleasantly surprised that folks continue to make their payments, make their rent payments and such. But it's exactly that. There are resources out there helping individuals to make their rent payments and their mortgage payments, and that could potentially dry up at the end of this year. And then it's really going to become, how is an economic issue? Are folks employed? Are they bringing in enough, to keep a roof over their head and their families fed? One of the things that's got us a little bit concerned on the single family side is that we did notice that once COVID kind of struck and this forbearance programs were put out there, is immediately we had a slug of folks coming in looking to get on a forbearance program. And fortunately, it kind of plateaued relatively quickly and just kind of stayed at that number. Some would add on, some would drop off. The concern is that we originally did most of those forbearance agreements for a 3-month period of time. And now that 3 months has passed, you're seeing that a lot of those individuals are looking to extend that, for another 3 months, potentially another 3 months. But as we know with forbearance, you're just taking payments that are due at some point and you're putting them off. So that hole for these individuals is getting deeper and deeper. So it really is kind of something that we look at, like I said, on a weekly basis, look at the data so that this doesn't creep up on us. We see what is potentially coming.
It's a really vexing situation, and I know that the No Labels group, the Problem Solvers Caucus, I know in Michigan, Debbie Dingle and Fred Upton are both members, have tried to put through, compromise legislation on that. It didn't happen before the election. I don't know whether there's going to be time to do it now, but we really have to get that rental assistance because canceling rent is not an option. And I'm not sure why we would even do that for people who are still employed. But it's somehow the half of landlords who are actually small business people need to be made whole as well. And that's going to address the moratorium issues. These folks are not unemployed through any fault of their own if it's because of COVID, and neither are the landlords. I don't think we want to see all of our apartment buildings owned by hedge funds in New York either. And we actually saw quite a bit of that during the single family crisis 10 years ago.
That would be a disaster.
Yeah. Do you want to add anything to that, Tia?
Other than it would be a disaster, it really is quite scary. It really is quite scary. And I don't know that we have folks leaning in. I mean, like we know, but our government partners, are they aware of, if we don't do something to help this, there really is kind of a cliff, and that we need to have some kind of safety net here before we actually fall off the cliff.
Let me ask you, are there ways that you're working to actually help some of these small property owners?
Yes. So with the 300 million we were provided for in the National Mortgage Settlement Fund, I said the first 50 million went on housing counseling. We're looking internally to stand up a program for small landlords for mortgage assistance to small landlords. I don't think it will at all be enough, but at least we'll probably be able to stand up and provide an infrastructure. It's 1 to 4 units. We're really trying to target those resources into those areas where the folks have been most impacted by COVID. And so those are some of the things that we're working on internally.
Another question. I was curious to see as to why the federal government should be doing what they should be doing towards rent. I understand that rent may not be canceled, but are there solutions to address the increase in debt?
Well, in my mind, that's why rental assistance is so important. Because if rental assistance were provided to those folks who cannot pay their rent, they're then able to pay their rent, and then those landlords and property owners are then able to pay their mortgage, which then gets to that debt. So that is the biggest way I see the federal government can step in and most immediately address this issue.
Let me ask you all, one of the things that we're seeing in the mortgage forbearance space for single family forbearance is a failure of as many as a quarter of people not to take advantage of the forbearance that's being offered to them. Is that something that you're seeing, and what are you doing about that?
Are you talking about specifically the BAT debt that's due?
The forbearance for mortgage holders, that there are people for single family residential who are not taking advantage of it, even though it's available to them.
Well, that's one of the things that I'm really hoping the counseling services will be able to provide, is because there is a break in communication for folks really knowing what's available to them. And so we have 3 HUD intermediaries we have under contract, which have a network of 97 housing counseling agencies. So we really are looking to use that network of housing counseling agencies to get the word out to homeowners and folks who are in distress, homeowners in distress, and renters about these are the housing services that are available to you so that we can help you continue to be housed. I do want to address the back debt issue too. I think I saw that in the chat.
Yeah.
For our mortgage assistance program, what we're literally looking to do is to make that mortgage current. So that mortgage, and so that we are actually putting the landlord in a place where they are able to sustain that mortgage. We're also looking to see if we can pass that benefit on to the tenants, so that if we are helping you, landlord, become whole by bringing your mortgage current, because you weren't receiving those rents, ensuring that you're passing that benefit along to the tenant, and you're not then going to evict that tenant for non-payment of rent, because you've pretty much been made whole by this mortgage assistance. And so that's the needle that we're trying to thread with our small landlord program.
Yeah, I just saw someone to your point. I just saw that somebody asked if that benefit's going to the renter or if it's going to the owner of the development, and really it's both. I mean, if you're we have this eviction diversion program where you're going through and you're helping to make those rent payments so that they don't fall behind. You're helping that individual, but you're also helping that the owner of that development, owner of that affordable housing, giving them the ability to remain current on their mortgages.
Yeah, and I just put on a site, covidhelpforhome.org, which is a collaborative effort that has been led by the Urban Institute to help get the message out. Let me go back to the FFB program. I know I worked on that at Treasury, and I think we're lucky that Don Graves and Buzz Roberts are both part of the Biden transition team, and they invented it. So it's I'm hoping it will be at the top of their agenda. But tell us a little bit about how that worked and why that was so valuable to in rural lending, because I think you in Massachusetts and New York had such quick take up on it, people assumed that it was really for more for urban high cost markets.
We use it from everything from rural communities all the way to urban communities. We did it for rehab. We used it for new construction. So it was such a flexible, low cost source of fund that had such a wonderful execution. And thank you, Buzz. And who's the other gentleman?
Don Graves, who's leading
Don,
Treasury.
thank you. Please make sure it's at the top of your list. But we used it a lot in our rural communities because what we found was that small loans and that a lot of these properties were smaller loans, rural communities weren't receiving a lot of CRA or a lot of attraction from traditional lenders. And so we as the HFA were able to go in and quickly target those resources in some of our rural communities. Some of our best projects were happening in rural communities that needed the financing, needed the low cost, but wasn't able to find resources in other places. And to be able to pair that perm source finance with a tax credit or other resources, it was invaluable. We did just as many projects in rural communities as we did in the urban communities. I think all total we did 23 to 26 of those FFB executions over a 2-year period, some refis, some new construction, and it was a mix in both urban and rural communities.
So let me ask, we have obviously a new administration coming in. It's obvious to most of us. And on January 21st, we'll be looking at the first 100 days agenda. From the perspective of housing finance agencies in the field, what would you say are the highest priorities you have for the first 100 days and for the first year?
For the first 100 days, I'd like them to get in and HUD, staff HUD, because HUD has been decimated, absolutely decimated. And to whatever they could do to, I think there's special provisions where you can bring in HUD experts and technical consultants and get them converted into civil servants. But if you go take a look at HUD offices, and HUD DC headquarters, they're completely decimated. So you're not going to get anything done and through HUD until you staff up. I'd also like to see some of these things that can be done administratively to be able to done quickly, because I think those will get resources going to these areas that need it the most: disaster recovery, COVID recovery, those kind of things. I think those are the two big things I think that they need to really go in and assess, because it's scary that HUD staffing is at the levels and the morale that they have at HUD right now. And if you were going to try to start sending things through HUD, big programs, big initiatives, you won't be able to do that without adequate staffing.
And longer term?
Longer term, I would like to be able to see HFAs have the ability to securitize HUD risk share loans. I think that is a complete missed opportunity that we are not taking advantage of, and it really doesn't make much sense that we're not. NCSHA has a whole list of legislative priorities that I cannot think of on the top of my head, but we do have a website. I'll make sure that goes in the chat session that kind of lists what of our higher term ledge priorities are but you can get a good snapshot because Stockton Williams, the executive director of NCSHA, has done and Garth, who may be on this call, he could probably put in the chat box the list of CalHFA's not CalHFA, but NCSHA's legislative priorities, because that was all of the housing finance agencies in the nation coming together and creating that list. So hopefully Garth can put that list of our kind of our big picture, what we would like to see.
And Jeffrey?
Yeah, definitely from a short-term standpoint, it's resources for dealing with rent and mortgage payments. I mean, that's something that until we get past COVID, it's something that has to be addressed. If it's shelved and they feel that those aren't resources that are necessary to keep folks in their homes, I think, like Tia said a little bit ago, we're going to fall off a cliff. I absolutely think that that's a priority. And then the long term, we'd like to see, the true pricing on the 4% low income housing tax credits. That would help from a gap standpoint to be able to get more affordable housing done with our tax exempt bond programs.
I'm glad you mentioned that. That's something we've been working on with the Affordable Housing Tax Credit Coalition and others, and really an important bipartisan priority. We're going to have to really find as much bipartisan priorities as we can as we go into what will be a interesting navigation of the politics with either a 50-50 Senate or close to it, and a narrow majority in the House for Democrats and a Democratic president. Let me ask about the technology investments in housing agencies, and there's a lot of different progress being made there, programs underway. Can you tell me a little bit about what you're working on, what the lessons learned are from working with each other?
Amongst the HFAs, I think we are a pretty close-knit group, and NCSHA has done a fabulous job of bringing us all together so that we have lessons learned. We have both topic listservs. We come together regularly, but I think that is the best way, is to learn from your colleagues and what they're doing. I know, for instance, we were updating our technology on our multifamily platforms recently, and we were having a very difficult time, and we reached out using the NCSHA listserv, and North Carolina HFA stepped up and had a platform that worked wonderfully for us. And so we do have a network in which we work very closely with each other. Also, the NCSHA staff always are bringing forward information to the HFAs so that we can hear from various panelists of what's going on. And so if there is information you are trying to get to the HFAs, the best bet is to go to NCSHA staff, and they regularly get that information out to our sister housing finance agencies.
Great. And speaking of NCSHA, thank you, Garth Riemann, for posting the 2020 priorities in the chat box. And I hear you're hard at work on 2021. Any final thoughts as we wrap up, and what do you think, our members need to really be focused on and moving forward here?
One thing I would say is that I continue to be impressed with how well that the HFAs work together across the country, and it's that sort of single voice that helps us get through some of these real challenging times like COVID. I think that it really says a lot about how we know how to prioritize and actually get things done, because it really does feel like instead of everybody kind of sitting back and trying to deal with their own small business or whatever it is, it's really, you're seeing people come up with some incredibly innovative ways to continue to move affordable housing forward, and the concern that's shown about making sure that people are staying in their rental units or staying in their single family homes has been just impressive.
And Tia?
I'd like to reiterate the need to see federal support on rental assistance and mortgage assistance, as Jeffrey and I have repeatedly said. And having all of your members leaning into this issue of the states can't do this by themselves, the locals can't do them by themselves. These folks are unemployed and jobless because of no fault of their own. And there is debt due and someone must pay it. So how do you ensure that those renters who aren't paying their rent and debt that's not getting paid, that system doesn't fall apart? And I would lean in hard on that rental assistance and mortgage assistance.
Thank you. I couldn't agree more. Thank you so much, Tia and Jeffrey, for your incredible leadership in increasing affordable rental housing options and everything else you do. I appreciate you both taking the time to join us. And thank you for all the participants for joining NHC on today's webinar. Hope you found the information helpful for the important work that you do. And I hope you'll join us for Solutions for Affordable Housing, our online convening on Tuesday, December 1st. You can find more information on it on the homepage of our website, nhc.org. And I see that Andrea also just posted a link. This event will feature incredible leaders to discuss pressing housing priorities for our country and for a new administration. And today is the last day for early bird registration. So save some money, register today, and don't wait for Black Friday. We hope we will see you there, and we always appreciate all of your participation and your membership. Thank you, everybody. Have a great day and a great weekend.